Good morning, traders. Welcome to a new month. May is behind us. We are starting June, and we are going to start with a bang. We have Bank of Canada today, but let's first go over a bit of news that we saw during the night. So basically, on big news, there is not too much going on, although late last night, OPEC came out saying that although there's no formal push to pump more oil, some members may plan for it because they want to take Russia out of the equation for the oil quota for now. So countries like UAE, Saudi Arabia could be starting to pump more, and that weighed a little bit on oils, although we did not see that big a move. And the rest we heard from Bostic trying to crawl back a little bit on his pausing comments, saying that he was not talking about a Fed put. As a result, US yields are keeping their bit tone together with the rest of the yields, but anyway, I mean, he didn't really say that people should take it for granted that they will really pause and do less than expected. Other speakers, we heard from the Bank of Japan, Wakatabe, saying that they will continue to ease the usual yen should move in line with the fundamentals, but that didn't have well, it actually had an inverse impact on the yen, if we can look at that that way. But so it does dampen the expectations for a possible shift or turnaround for the Bank of Japan later this month a little bit. So we have to watch out for those for more comments. For the rest, there's been Russia comments in regards to what Biden was saying yesterday about sending weapons to Ukraine, and they came out this morning saying that any weapons going from the US to Ukraine would risk a direct confrontation between Russia and the US. China came out a little later with similar comments, saying that after Ardern and Biden meeting, they should take care of their own internal policies and leave China's policies alone. And then last night as well, we had these rumors about Russia nuclear drills, but the market hasn't been reacting to any of those really. It seems that we are in a global Alzheimer period again, where the market is only trading central banks, inflation, and for the time being, risk is getting put aside for a little bit. Let's go over to what the data brought us overnight. So I will share a different screen. There we go. I hope you all can see that. So not that much, although we are the 1st of June, traditionally the manufacturing PMI day. So we have to be a bit careful about all those PMIs coming out. The first ones came out of Australia. They did not really move stuff too much. We also had Q1 data, Aussie out. It did slow down, but not as bad as expected. The Aussie is still keeping an overall pretty bid tone right now. The Chinese PMI came out a little bit better than expected on the hopes of the reopenings, but still remains below 50. This is something to note. And also to note with China is that the forwards have been melting down a little bit, which has caused dollar China to crawl back up from 666, 667 to this 670 area. On the rest, okay, we had disappointing German retail sales, but the market didn't really trade any of those. I think we need to see a couple of months to confirm this, whether it's a trend or just a setback in April. And for the rest, the Eurozone PMIs, barring the let's call it traditional miss in Italy, the rest came out relatively as expected. So that hasn't moved the market at all. The only one that caused a bit of a stir is Austria's ECB member Holzmann, again, stressing really that ECB should now do 50 BPs relatively soon. He has already been in that camp. He is a hawk. We know his thoughts, but after yesterday's Eurozone inflation data, this time he might be heard a little bit better than before. We could be hearing from Not, the Dutch ECB member as well. A bit later in the day, he is also, or he has been in the 50 BP camp, but the last ones he said it's going to be gradual as well. So we don't know really whether he's going to keep that 50 BPs. But again, after yesterday's inflation data, I guess we are going to see more calls again for the ECB to move faster. Yesterday we spoke with Stelios about this, and we were actually wondering whether June could already be a meeting where they announce some stuff more firmly than July. ECB has this sequencing put in place where they can, or they say they can only start to raise rates after they stop the APP program. So they have to announce, so far, they have to announce the end of the APP program before they can start to raise rates. Now, they could say that they end the APP program straight away and then announce straight away a rate hike. But the ECB being slow, they could they normally would wait for July. The issue with that and the issue with the euro is that we are going to have more rate hikes from other central banks before the ECB even starts, and we don't know the frequency nor the size of the ECB hikes. So is it going to work in favor of the euro remains really the question for now. What else do we have? Oh yeah, to come back quickly on that Aussie GDP, since it came in a little bit better, we have the RBA next week. The market expected they would do 25, but there is a bit of a risk that since the economy is holding better than what people would have feared, is that they would go for 40 BP. I am still in the mildly positive camp Aussie until we get into the RBA, but I'll come back on that a little later as well. And I think that news-wise, or what we had, that's about it. There was not really that much to talk about. So let's look at what the calendar has in store for the rest of the day. So as I said, it's PMI day. So we are going to have US, Canadian PMIs coming out as well. And then the big one for the afternoon will be the Bank of Canada interest rate decision. And the market is expecting 50 BPs there. Some are calling for a possible 75 BPs move. It's not my preferred scenario because I don't think that central banks are really there to overly surprise markets. They have been hawkish enough, but 75 BPs is what really would be needed for the Bank of Canada to be even more hawkish than what they are now. We had a little setback in the Q1 GDP data, which is a little in line with the US, but not really surprising. And I don't think it's going to change the Bank of Canada's stance right now. So they're going to continue to push on the pedal to hike. The market is pricing even more hikes until the end of the year. But I think we are going to have, once the summer is gone, we are going to have to take things meeting by meeting, because then we will have a lot more economic data and a lot more data points to fall back on and to judge whether those central banks are going to continue to press very hard on the hiking pedal. So. Well, and apart from this, we also have like some more speakers. Lagarde is talking during the day as well. It's not clear whether she will be mentioning anything about the monetary policy today, what the speeches are concerning, and then later in the day, around 7 p.m. our time, 6 o'clock GMT. 1800 GMT, we'll have the beige book coming out. That is the details of that you can see when you click on there is an economic current conditions metric in which each of the 12 federal districts give a picture of the economic trends and challenges in the US. The Fed is looking at that. So if I would be you, I'd be at 6 p.m. GMT, I'd have a look at this beige book coming out. Okay, so let's move on to, I think I've said most of, yeah, let's move on to a bit of, let me change the screen again. Where is it? Excuse me.
Morning, K-Man. Morning,
hey,
everybody.
Stel.
How you doing?
Hey, Stel. Yeah, I was just going to go over to the options and then over to some pretty pictures.
Mm-hmm.
So just on the options here, I hope you can see the screen. There's a bit going on in the neighborhood, but none of the amounts are really very big, apart from one, which is right where we are now at 617, the dollar China, which is about $2.5 billion, all calls. It could be that we're capped above 670 because people having those calls on the books might be tempted to hedge a bit of their outstandings when it comes close to expiry. So yeah, still I already meant the Bank of Canada to come, a bit of shenanigans between Russia, China, and the rest of the world again. But for the rest, not an awful lot on the overnight news docket. So I think we'll better have a look at the Bank of Canada and what it could have as implications on the Canadian dollar, unless you have something that you want to talk about.
Me?
Yes.
No, I mean, it's been a quiet day, like you said. The Bank of Canada is the big kind of big event today, but I don't think they're going to surprise with anything other than a 50, which is expected, and it's probably the right thing to do. You talked about German retail sales disappointing. It's a pretty volatile number, but in the past 12 months, it has been surprising to the downside relatively consistently. So I think we are seeing the beginning of a trend. And, given the fundamental backdrop of diminishing disposable income, it makes sense that people are spending less. And remember, retail sales is not inflation adjusted. So it's, you're spending more doesn't mean that you're spending more. Basically, you're paying more for products anyway due to inflation. That's going to be rising. It should be a quiet day. We have payrolls, non-farm payrolls on Friday. So that's going to be the big one. And what else is there to say? I mean, the markets are relatively quiet today. Equities are kind of flat. Even big cryptos are flat, which is crazy. Mm-hmm. Oil is being bought on every dip still. You talked about OPEC. I just think the whole environment with the EU's decision to ban at least certain types of oil inflows into the European countries, that's going to keep supply limited. And somebody was mentioning, have to go back and check it if it's true, but somebody was mentioning that Saudi Arabia is pumping less than they were pre-COVID. So that's I have to check that. I don't know if it's 100% accurate, but I did read it somewhere. But overall, I'm sure the OPEC producing countries are not unhappy with these prices. Their product is as expensive almost as it's ever been, and what you usually see in these environments, you see producers hedging their future output. So if we get I'm sure they're probably doing it already, but if we get near those all-time highs, or was it 130 something, that's I think that's going to be a strong force to kind of put a lid on it. But for the moment, energy is expensive and is getting more expensive. So goods and services are getting more expensive while GDP is turning, while consumption is turning lower. This is not a good formula for the global environment, unfortunately.
Stelios, while I have you close there, did you see this Bank of England thing where they said that they might get involved if some of the stable coins would collapse or so?
I didn't see that. No, some of the stable coins.
Yeah, there was some weird comments actually. And
I missed that completely.
On the chat this morning, one of your Greek compatriots, by the way, put it on the chat this morning. I was also a little bit surprised that they would say like they could get involved if they feel that some of the stable coins would represent a risk to the economy, or risk to payments, or risk to credit if they would collapse. I think it's something that needs to be further.
That is very surprising. Go on.
And especially monitor. The thing is, we can never forget, because when we talk about central banks, we have to talk about the people who represent those central banks. That Bank of England Governor Bailey is a regulator. So I wouldn't be surprised if he feels the temptation to get involved in stuff that he should not really, in normal times, not get involved in. But he's a regulator, right? So
he was chairman of the FCA before.
Exactly. So we have to bear that in mind.
I am very surprised, because it really is none of the Bank of England's business what cryptos and what stablecoins are doing, because they're not regulated. They're just something. It's like them saying, "Oh my God, I think the collectible baseball cards in the US are going to crash. We might get involved." It's obviously there's a lot of money that has been made in cryptos, and there's a lot of money at stake now. But this is something that's outside the banking, mostly outside the banking sector, and I don't think a collapse of bitcoins would cause.
It's not Bitcoin; it's the stable coins, and they were rather hinting at stuff like Tether and things.
Well, Tether is one of the vehicles via which cryptos have been bought for months and months, right? So if Tether collapses, then that's going to be very, very negative for cryptos, for every crypto. So, but personally, I don't see why they would get involved.
Unless they take the excuse that some of the stable coins collateral, or what they are
backed with,
has something to do with sterling. I don't know. If that's the case, then the central bank could possibly create the excuse to get involhed, right?
Yeah, maybe. I don't understand it.
It's a far-fetched. I agree. I don't really see why they would either.
I don't see how a collapse in those would have a ripple effect on the economy. Obviously, people will lose money, but this is still kind of a little universe of its own. But anyway, let's see. Let's see.
Let's go to the Bank of Japan and look at a couple of charts that I found interesting this morning to see what can happen on the Bank of Japan. So the first one is obviously the dollar Canada. We are on a medium term fib here, which is at 126.35, which is absolutely very, very close to the market. We are on it. And then we have this price low 127, call it 15, 10, 20, somewhere like that, 15, call it. But what's interesting here is that on the daily, the confluence, although I'm not a big M&A fan, which I already said, but this is relatively interesting because it's close to the market. We have a big confluence of the 55, the 100, and the 200 DMA, which are all between 126.5 and 127. So we could call this a neutral zone, I think, because we also saw earlier lows, highs, multiples, which are all in this 126 and a quarter, 127 zone. So we are in a bit of a neutral zone. So any Bank of Canada surprise could take us out of this short-term comfort zone, in my opinion. And if we do, then we are going to have to look at the broader triangle, or in between 138 and a quarter, 128 and a quarter, I'm sorry. And then on the downside, we could, if it breaks, we could be having a quick look back at the 125 figure 40 zone. That for the dollar Canada. Has to be said, though, that a lot of the yields right now are really moving in tandem. So we find, apart from the yen, which I will come to in a bit, we find a lot of those dollar pairs are in relative ranges right now, because yields have been moving in tandem, because all the central banks are started to hike. All the central banks want to fight inflation. All the central banks will have to do something and do something about their yields. So the dollar pairs have been in a relative stable environment of late, although we do get pretty violent intraday moves depending on the yield moves and equities, which we'll have a look at later. The other pair, which I'm going to have a look at now, is Canada yen, and that brings me to the yen. Yen is suffering big time. Oil is going higher, energy is going higher. Yields are pushing up across the globe, and we hear Bank of Japan, Kuroda, Wakatabe overnight saying that they are still in their easing process, and they will be very slow to react. So the yen took another beating overnight. Canada yen is no exception. And then look at this. This is possibly the bull flag, which has broken a couple of sessions ago pretty violently. And now we could be on our way to new tops. Of course, we have to be always careful with what we think that may happen. We have to let the price action decide this. So we are going to keep an eye on the 103 after the Bank of Canada today, and the 101, basically 101, 103. And if 101, if the Bank of Canada would disappoint, which I don't think they will, we could have a look back at 100, but I wouldn't think so. I think they are going to keep 50, and then we'll see the reaction in the Canadian yields, if we can break this 103 or not in the Canada yen. But this thing looks impulsive again. And the last one I want to show on the Canada is the Eurocat. Just a sec. So this is a bit the wider picture. And even if the euro and ECB is trying to start to change, if you look at the global picture of this one, this is really, really, really tough to get off the ground. We are having major difficulties to stay above this 137.5 line for now. And if ECB keeps their slow approach to what is going on, this low that we did earlier in May is really going to be at risk, in my opinion, around the 134 zone. And then if that would give way, then we are talking about 130 really in the medium term. Short term on the day, I'd say watch these intermediate levels, which is the low that we printed 135 the figure, and then the higher, a bit higher, around 136.75. Then we start to talk about 137 again, if the Bank of Canada would disappoint. But again, it's not our base case. Anything you wanted to add on the Canadian side of things still?
Not really. For me, I've found it pretty difficult in the past months to have any kind of firm bias on the Canadian. I mean, USD CAD, if you look, has been from the lows of 123 until the highs of 130. I know it's a relatively big range, but it's been going sideways since mid last year. So I don't really have any. Yeah, there you go. I don't really have any conviction on the CAD, I'm afraid.
Yeah, we could argue it's been volatile, which actually for ForexAnalytix listeners and people in our chat room, we've been saying for weeks and weeks that volatility will increase with higher yields and more uncertainty lying ahead of the economy. We did repeat that endlessly and saying that volatility will increase. We're seeing a higher volatility, but so far in dollar pairs, in broad dollar terms, and looking at the other side of dollar pairs as well, we are still in wild but ranges, right? So we have to keep that in mind, that the market is usually 80% of the time in ranges, and only 20% of the time we get breaks, sustainable breaks. So keep that in mind. So yep. Let's get back to our yen. For yen, it's really it's yield driven. Look at the yields, and then look at the yen. It's a perfect overlay. Yen is suffering when yields are rising and the Bank of Japan is slow. Yen is suffering. So adding to that, what I already said about oils and energy in general, as Japan is a big importer. So keep an eye on this 129.70. I'd say in dollar yen, that's our next, and possibly when we look at those highs, those lows here, the peak high. Possibly the gateway to get back above 130 up to 130 and a quarter, and who knows what else is in store. We still have quite a while to wait until the Bank of Japan, another 2 weeks, and in 2 weeks a lot can happen, especially if the rest of the yields continue to push on. It wasn't my favorite. I thought we would be stopping somewhere in the 128.60 because of Corona, because of possible a bit of risk to economic data. But then you see those PMIs come out in line above the 50s in the Eurozone. There's not a lot that is telling us right now that yen, from a risk point of view, can strengthen. So we are going to have to really monitor those yields and probably equity markets, what happens at the start of this month. I'd say first levels on the downside, that's a bit close, but I'd keep a close eye on 128.60, broken, retested, and took off again. So 128.60 is going to be my level to watch. We could take all the yen crosses. They're all going the same way. They're all breaking. They're all the euro yen broke the triangle since ECB started to change tack a little bit. Also into the end of month, euro yen is breaking up. If this holds 138.40, we could push up into the 129.20 zone perhaps. This high again, but it's really the same for all the yen crosses. One that I would like to quickly mention today, and my chart, what happened there? My chart has gone away again. Anyway, let's do it without any. That's strange. My chart has lost the setup again, but we can see here from after RBNZ. And right after, RBNZ raised rates, and then right after there, the market decided to take profit on this Aussie Kiwi, and we are already trading a percent higher again. I think that purely has to do with the RBA. Once the RBNZ was done, then the market turned its attention to the RBA. And we are purely trading what's going to happen with the RBA right now. I'd say that okay, it's broken this short term. It's broken this short term little trend line around 110.35, which is not far from here. So watch that in the really short term for a hold, perhaps. But I'd say, is there any reason to get back above those 110.80, 111, the figures? Unless things turn really sour in Kiwiland, I'm not sure we are going to see much higher levels. But what I can see is that we find buyers on dips in the Aussie Kiwi right now. What else? Is there anything else you wanted to talk about in currencies, or before I move on to metals also?
Not in currencies. I wanted to mention yields actually.
Okay.
Are you going to be talking about that afterwards?
Yes. Can I quickly show one?
Yeah, sure.
On here, Euronoki broken above this downward channel and had a violent move up. Dollar Noki went up like really. This move has been really impulsive, and then we stopped around this zone from late 2021, and then since then we came back off because oil is holding. Norges Bank is taking down a little bit their Norwegian sales, Norwegian kroner sales this month versus last month, and Brent is holding up pretty well. If after the and I said after the EU plans to cut back on Russian energy, Norway should be one of the beneficiaries. So I'd be looking at selling rallies, and it's holding. We have to respect this double layer of support, and just above 10, we have the fib there. We have a trend line support there. We have to respect this little zone, but I would say anything back towards the 10.15, 10.20 zone, I'll be looking to add to my small leftover shorts again. And we can talk about Khaled. Yes, I've seen your question about metals. We are going to come to that in a minute, but we can talk about yields. Which ones?
I was looking at the 10-year US, and I just wanted to say we've had the pullback from the highs, but if you look at the daily chart, are you on the? Yeah, if you look at the daily, we basically bounced off the 50 DMA, and if you know, I usually look at a longer time frame chart, so I look at the daily, and I usually scroll out a little bit. If you look at the move we've had.
Pull up the.
Sorry.
Let me pull up the 50.
Yeah. The 50 moving average, 50 DMA. And we were discussing that. Yep. So we have bounced off that. What worries me for in terms of how yields are going to go, and I've said it before, I think we're going to break above the 320 level and go to new highs. What worries me is that this retracement from, say, the March of this year, we were down at 160 something, we went up to 320, so 150 basis points, and the retracement is so shallow.
Yeah.
So that just tells me that I think we're going to go straight up and break those highs. So if I was short yields, if I was long bonds, I'd be pretty worried at the moment because I think with inflation still ramping and central banks still telling us they're going to be fighting inflation, there's nowhere, you know, they shouldn't be anywhere near here, 10-year US. And obviously bonds the same, and most government bonds, benchmark government bonds. So yeah, exactly. So I think
as
we're going to
speak, is this again? Whoops. Come on, get out of here. Is this again bullish pennant or?
Well, it's some kind of bullish consolidation, and it's really the retracement is very small.
So bullish triangle or pennant, whatever. It's yeah, the risk is there that this goes back up, and I fully agree with you, right? And we were saying when we were down here on the face experience, remember we were saying like, but how much more room does it have into QT and so we were really not sure whether this thing would have much room to go down.
Yeah.
Oh,
Our friend Gavin is saying you could look at that and say it's a head and shoulders pattern. Yeah, you could do, although the right shoulder looks a little bit asymmetric now, and I'm not convinced. But yeah, of course you could.
A hunchback of Notre Dame head and shoulder.
But yeah, I've said it for weeks. I think yields are driving the markets at the moment, mostly. So if we do get this push forward in yields, I think that's going to push risk assets lower, and the dollar is a different question. You know, if somebody told me 10-year US is going to go above 320 and go towards 3.5%, is a good dollar going to strengthen or weaken? I can't be sure. That's a problem at the moment. The dollar.
Yeah. But I think you and I, or the people looking at it from a bit more fundamental point of view, this is the market we are in. You have people saying like, yeah, but, and others saying like, no, but if the rates rise again and if the economy, everything will depend on data. But we are in this 50-50 zone, right? Where fundamentally some are crying for a catastrophe and the dollar going down the drain. The other one saying like, yeah, but maybe not. The economy can withstand, and then it's going to be roses, and the dollar is going to fly high again. We are in this period where you could easily find enough reasons to go either way.
Yep.
Yeah, we are in this kind of environment right now.
Yeah.
Okay,
Cayman, I actually have to run. I'm going to let you finish up with metals or whatever else you need to say.
And
we'll see everybody on face later today.
Yeah. Okay. Thanks, Delios.
Thanks, Cayman. Thanks, everybody.
Yeah. Thanks. I just wanted to show on this while we are on the rates and to show exactly why the yen is suffering. If you look at the short-term dollar rates have now flattened out a bit, but the rest of the world is catching up. The German rates are catching up. The longer end on the dollar end is still very buoyant, and then you see the German rates as well. They are trying to now get back above this 115, 120 zone on the German 10 years, and all of that is really weighing on the yen. For guys, if girls, and if you want to trade the yen, keep a close eye on yields is very important. And then before I go over to your questions, I want to show you two simple charts on the euro. We have been like trading short term in this upward channel, and we are now stabilizing here around here, waiting for a new direction. As you know, I'm looking at this big 108 figure 30 zone on the longer term, and then on the downside, see what happens at 106.40. We have an intermediate station here at 107.40, but we have been breaching it up and down. I don't really think it's that important. But what I really wanted to show you is that keep this picture in mind, this one here, and then let's move over to the other one, and this one. And this one is the differential between the German 2-year and the US 2-year. And you remember this channel in the euro dollar? When we hit the low when we hit the high on the differentials, the biggest difference, because you can see it's an inverted, when we hit the biggest difference on the euro yields versus the US yields, the euro dollar hit its bottom. Since then, we have been reversing. And what happened to the euro dollar? Exactly the same. So yesterday, I wanted to come back on this because yesterday with Gregor, we were talking about correlations. This is another perfect example of correlations. And this is something that I always advocate to people who want to learn more about fundamentals, want to learn more about correlations. What are we looking at? For people who have been longer in the market, it's no secret, but for new traders, this might be interesting. What are we looking at? Well, we are looking at this to know whether either we have to jump into a position or trade this, or at least if we are longer term euro-dollar pairs, if we look at those yields and if we see those yield differentials start to go the other way around, we are going to either scale back or at least be very, very cautious with what we have on the books. So that's something I wanted to show you today. And now I'm going to go over to your questions. So the first thing is was the metals. Okay. I've been showing this chart a couple of times on gold already, and we are in the zone. Okay, if for the shorter term trader, I don't like this. I don't like this break back below the trend line. I don't like the break back below the 200-day moving average, but for the 200-day moving average, we always have to consider the close, of course. But we are still in this FIB support zone. I think if yields are seemingly stabilizing a little bit now, but I think if these yields continue to push higher, this is at risk, this 1828, and I could see another $20, $25 in there if this 1828 will really give way and start to hold. For the time being, I have no positions, but I'd be a bit careful with this here. If we break, we need to go back above 1840 and ideally confirm through 1846 to start to get more bullish again on gold. If we move over to silver, I'm really okay. Since we hit the Reddit high, we can argue that we're in a downward channel, but then again, it's a dollar move, and it's a move which also tells us that the market is not confident in economic hold for now, but we are on a pretty important zone here in 2140s on silver. If that goes, we could see it back to 21, and then on to that retracement zone here at 20. I think the 2090-21 zone is going to be pretty important. Right here we're on a support, and we can see, as we were talking about this a little bit earlier, we can see we tried again to break this 22 figure 15 zone, figure 13 zone, failed again. I'm not inclined to do much. I'm still very, very tiny long-term long, but I still would not exclude that we are going to, if the global economy falters a bit, that we could even make it back to 18.5, 19 in the longer term. Short term, if you want to trade the range, trade this 2140, 22 and see what happens, but be careful if it goes sub 21, 2090. Is there a connection with yield? Al, can you specify what instrument you're looking at? USA what? USA against a currency, or the dollar in general, or well, okay, I'll come back to that. Just do you think the housing market? I'm taking just the next question. Naha, do you think the housing market will have an effect on the Canadian decision today? The housing market will have an effect on not on the Bank of Canada today. I wouldn't think so. I think what we need to look at the housing market. The housing market shows signs of slowing down everywhere, right? Sorry, but we need to look at it. In my opinion, anyway, we need to look at it from the point of view of like where are we compared to 2019 situation before the pandemic? Did people put their checks to good use? Or but housing markets have exploded everywhere, and it's getting very, very difficult to pay those prices when yields are starting to go up and to pay mortgages. So there is a normal fact, in my opinion, to say that the housing market has to cool down from levels that we have seen. But will it impact the Bank of Canada decision today? I don't think it will impact the decision today, but they might say something about we are monitoring the developments in the housing market. If we continue to be at those lofty levels, they won't see an argument to stop raising rates, because if the housing market holds up, why would they stop raising rates? If the housing market shows signs of a very big downturn, then in turn it might make them think. But I don't think we are there anywhere close yet. So Alma, I still don't really understand your question, because is there a connection with USA yield? In what are you in relation to what? USA yield in relation to what? Because we talked already about yields today. We talked about the 10-year yields to gold. Yes, I think there is a dollar factor in a yield factor in the metals. It does play a role, just as there is not always obvious a correlation with yields and dollar value in equity markets. But those are correlations which really come and go. There's going to be a bigger impact, I think, going forward, coming from the data to see whether we are going to go up or down in gold, because we know, and the market knows, that yields are on the rise and that yields are higher, and yet we are still in the 1800s in gold. We are not trading 1700s because yields are going higher. So I think the biggest impact will come from inflation and from real economic data, if you want. If the economy holds up very well, this one that I'm looking at now, if the economy holds up, this, I think, is one that people will want to have going forward. But we need more data. We really need more data right now. Are there any other questions? If not, we are going to call it a session. Okay, I don't see any more questions right now. So I'm going to thank you all for your company again today. Wish you all the best for the Bank of Canada, for the beige book, for the PMIs. Trade safely, manage your accounts. Don't blow it all up at once. Always make sure that you have the possibility to take the next opportunity. Opportunities are there around each corner, even if you miss one. So thank you all very much for your company, and we talk again tomorrow.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.